How's it, YouTube? And welcome to Financial Freedom. My name is Mr. Smit, and I'm going to be your safeguard to financial and accounting freedom. So you're probably thinking, why Mr. Smit? Well, it's simple, really. I am a fully qualified Bachelor of Commerce graduate specializing in finance and accounting. And not only do I possess the knowledge of being able to teach the foundational principles of accounting, but I also possess real life corporate experience, seeing accounting unfold in the real world. Plus, I find it rather unfair that I keep this knowledge all to myself, where there are others, such as yourself, seeking this type of information that I possess. So, whether you're a risk-taking entrepreneur, a high school or university student, or you are simply an accounting, bookkeeping, or finance professional seeking insight back into the accounting basics and accounting principles, and even to uncover some of the complexities that accounting has, you have come to the right place. Now let's get started. In today's video, we're going to be uncovering the accounting equation. But sir, what is the accounting equation? Hold on, I'm getting there. The key to understanding the accounting equation is by simply breaking it into two parts. Items, goods, or substances that the business owns is equal to the items, goods, or substances that the business owes. Hold up. One thing to remember here is that everything within terms of accounting is going to come back to this one word: balance. Everything in terms of the accounting equation and with accounting in general, you're going to hear it till the day that you die with in terms of accounting. Everything needs to balance. If things in the accounting equation do not balance, you will be in deep poo. The reason that I say that you will be in deep poo is because there are major ramifications coming to where financial statements or any of your accounting books do not balance. For every debit, there is a credit. Remember that. For every debit, there is a credit. So life in accounting, unlike modern day society, there needs to be balance. Otherwise, you will see the inside of a jail cell. Just say. Coming back from that tangent, sorry to scare you, but I need you to get some context. In terms of the accounting equation in modern day society, in business, is also known as the chart of accounts. So for all you wonderful professionals that use an accounting system, this is what your accounting system is based off. The accounting equation is also known as the chart of accounts. I think that's enough of my face right now. So let's dive into the accounting equation. I've got a few slides and it is a cheat sheet. So stay to the end of the video and you might just win. Okay, so let's dive into the accounting equation. Referring back to the previous part of my video, I broke down the accounting equation into two principles: items, goods, or substances that the business owns. So, what does a business own? A business owns assets. That is what the business owns. And an asset is classified as non-current or current. But don't stress about that. We're going to touch it soon. So that's the first part of the accounting equation principle: items, goods, or substances that the business owns, which is an asset. We now go on to the second part of the principle: items, goods, or substances that the business owes. Now, a business can owe items, goods, or substances through either investors or shareholders, which is known as owner's equity, so anything that the owner contributes to the business that we owe back to the shareholders and investors, or it's items, goods, or substances that we owe as a business to third parties, such as banks or creditors. This is known as liabilities. And there it is, the accounting equation. Assets equals owner's equity plus liabilities. That is the first part of it. But now, let's dive in to the nitty-gritty stuff. First of the nitty-gritty stuff that we're going to be diving into is assets. So now assets can be classified into two parts, current and non-current. But what is the difference? The difference simply is current assets have a useful life or can last for less than a year. That is a current asset. So you can use it within this current year. A non-current asset is an asset that has a useful life or lasts longer than 1 year. The different types of current assets that we have is your trading inventory or stock. So the items or stock that you have that you're going to be selling if you are a product-based company. Cash float. Your bank is also a current asset. But if you read closely, it says if it has a debit balance. If your bank balance has a credit balance, that means you have gone into bank overdraft, which means you now owe the bank money. So, for the benefit of your business, make sure that your bank balance is always on the debit side. Petty cash, your cash that's lying around that you have, that you can pay for your employees' bread, milk, or anything of the office consumables that you will need. The next part is your trade and other receivables. This is a whole section on its own, but it comes back to trade debtors. So people that come to your business, if you're a product-based business, and say, I want your stock, but pay with a credit card, they have in theory paid you, but will pay you at a later stage. So they become a debtor to you. So because they still need to pay off that debt that they have to you. Account, your savings account is always going to be an asset, because some savings accounts you just go and it accumulates growth and growth and growth if you put it into the correct savings account, I must just say. Then finally, if your country of origin deals with VAT or GST, known as goods sales tax, it is beneficial and it becomes an asset to the business when we get a VAT refund or a VAT receivable, or we get a GST return or a GST refund. Those are your lists of current assets. Because remember, current assets are assets that last for or have a useful life of less than a year. So we're moving on to non-current assets, which is your land and buildings. They last longer than 1 year. They're an asset to us. So all of the land buildings, whether it's your office block, your house, whatever, or the land that you've just purchased to build your new dream home, that is a non-current asset because it has a useful life of more than 1 year. Vehicles. Yes, vehicles are an asset. Although they depreciate in value, they are still classified as an asset to the business. Equipment, so it's the equipment that allows you to create your product or able to supply your service. So you're a product-based company selling t-shirts, it's the t-shirt maker or the branding or putting the branding logo onto the t-shirt. If you're a service-based business, maybe it's the lawnmower that you need to go and mow the lawn. Finally, which most people don't understand, is fixed deposits. Fixed deposits are the most underrated non-current assets. If you put your money into a 20-year fixed deposit account, it starts to grow at different interest rates and it starts accumulating. So it has its benefits and it is a non-current asset because it is a 20-year fixed deposit or a 10-year fixed deposit. That is why it is classified as a non-current asset. Now that we understand assets, let's move to the other part of the equation. First off, owner's equity. Owner's equity is based into three parts. The first of those parts is capital. Now, capital can be monetary, which means that the shareholders, investors, owners, whoever owns the business or has shares in the business, gives a capital injection through cash or purchasing of more shares so that we've got more cash on hand, which is share capital contributed. The second part is non-monetary. Now, non-monetary is the shareholders, investors, owners, whatever you want to call them, give a capital injection, but don't do it through cash. They give it to you either through property, plant, or equipment. So it's property, so the shareholders or the investors decide to purchase a piece of land and buildings and contribute that to the business, and they want to pay out from that. They contribute plant, which is the area or the whole warehouse that you're going to be working in, or they give you equipment, your lawn mowing business, and they give you the necessary equipment to go and do your service. Income. Okay, so income is named of little subsections. First off, sales. That is the number one source of income. You're now starting to sell your product. You're starting to sell your service. It's services rendered. So it's sales for products, services rendered for your services that you have rendered to your clients. The next part is if you are a landlord, you get income through rent. So you lease out or you rent out your premises to clients, and they give you income for the rent that they need to work on your premises. Dividends issued and declared. Now, this is a different type of income, but it's still classified an income. You are an investor, you've purchased shares into the business, you now want to get money out of the business, and you get paid not through salaries or wages, you get paid through dividends, which is either issued or declared. That we'll discuss in a later video. Finally, we get to the third part of owner's equity, which is expenses. Now, expenses are everything that you need to pay for. So everything that you must incur in order for your business to make money. So this is fuel, your salaries and wages to pay off your employees for the good work that they're going to be doing, the maintenance expenses because you have to look after your cars, you've got to have to look after your equipment, whatever. And then finally, the cost of sales, the cost that you incur to create the product. So to find a supplier that makes the t-shirts for you, or the cost to sell it out. So your marketing team, whatever, that also might go through salaries or wages, or you go through a third party, whatever. And then finally, the cost that we do not like, but we have to incur is depreciation. So the amount that decreases the value of your asset or your equipment, which will be incurred onto vehicles. But that is in a later video. Wow. Okay, so now owner's equity and assets are taken care of. We now move on to the final part of the equation, liabilities. Now, liabilities is the exact same as assets. It has got current and non-current, but have a different part. Okay, so current liabilities are liabilities that can be paid off in less than 1 year. So kind of like going back to assets, it is currently within 1 year that it is classified a current asset. If it's non-current, it's more than 1 year. The same applies to liabilities. If it is a current liability, it can be paid off in 1 year. If it is a non-current liability, that means that it has to be paid off in 1 or 2 years. So the different types of liabilities that we incur for the current portion is short-term loans. So your student loans or whatever, little loans that help you to go and buy the equipment that you'll pay off soon. Trade and other payables, otherwise known as trade creditors. So you go and buy something on your credit card. You still owe that business money. So that falls under trade creditors. They become a creditor and we have to pay it off soon. Then moving on to the non-current, we've got mortgage loans. And we all know that a mortgage does not get paid off in 1 year, if you're lucky. Okay, a mortgage loan normally takes to 10, 15 or 20 years to pay off. And that is a perfect definition. of a non-current liability. A little pre-bonus slide, okay? I'm going to be giving you a small bonus slide, but we're going to be moving on to this one. You might have heard the term proprietary accounts. Now, what are proprietary accounts? Proprietary accounts are the accounts that are controlled by the owners, the shareholders, the investors, whoever that you want to call it, okay? But they have control over these two things, okay? It is capital and drawings, okay? They can only contribute to the business, or they can only take out of the business. That is all they can do with these two accounts, with capital and drawings. Make sense? I'm so glad that you stayed to the end of the video. Now, we're moving on to a bonus feature before I give you that cheat sheet. This is a small acronym that will help you understand the accounting equation. So, let's get into it. Bonus feature time. The first acronym that I'm going to teach you is known as DAX. D-A-X. Now, what does DAX stand for? DAX stands for debtors and drawings, assets, and expenses. Now, what is the significance of DAX? DAX is the way that you're going to be treating your T account or your general ledger account. Right. So DAX means that everything on the debit side goes up. So it increases in value on the debit side. On the credit side, it means it goes down. That's what DAX is. That's how you will remember. Everything that's in terms of debtors or drawings increases in value on the debit side. Also for assets, also for expenses. And any number that goes to the credit side decreases the value of DAX. Okay, now the final acronym that I'm going to teach you, like I just taught you with DAX, is now LIC. Again, what does LIC stand for? It stands for liabilities, income, and capital. Anything on the debit side for LIC goes down in value. And anything that goes on the credit side makes the LIC account increase in value. And that's it. DAX and LIC. That is your acronyms to help you pass the T accounts and also understand the accounting equation. And that, my students and professionals, is the accounting equation. You see, not so scary after all. This is the first of many videos that I'm going to be publishing on this channel with regards to finance and accounting. I'm coming from the basics all the way to the complexities that lie within the accounting profession. I do hope that you thoroughly enjoyed this video as much as I did explaining it to you. If you did enjoy this, please subscribe, click the subscribe button and the notifications bell to make sure that you always kept up to date with one of my latest videos. This is one of the many part series that I'm going to be doing on this channel. If you have any suggestions, please don't be scared and put it in the comment section below, and I'll read it and make sure that I publish a necessary video accordingly, and make sure that I take it into account. See what I did there? So cringe. But wait, before you go, if you want to get hold of this cheat sheet and want to get hold of many other accounting cheat sheets that I'm going to be publishing, unfortunately I don't have a website up at this time, but you can contact me at learnwithmrsmit@gmail.com and I will answer accordingly and give you the cheat sheet. And YouTube, thanks for watching, and I'll see you at the next class.